Valentine's Day. My name is Alexis Rogers, and I'm the Customer Relationship Lead here at RightCapital. And I want to welcome you to our Right Training webinar on maximizing deductions through charitable giving. Now, this is always a timely topic, but especially as we're in the midst of tax planning seasons, we're going to be diving into how you can leverage a couple different key charitable giving strategies and apply them in a plan. So today we are going to be walking through how to actually model charitable giving goals, how to also incorporate a very popular strategy when it comes to mitigating tax exposure in post-retirement years, which are qualified charitable distributions or QCDs. And we're also going to look at how to model donor advised funds for those that might have it currently, or you might be looking to evaluate that option as well. And as always, towards the end of this webinar, we're also going to be reviewing the different resources that you do have available to you when leveraging RightCapital. One of those resources being that during this webinar, if you have any questions, please feel free to use the Q&A section to type out your questions. More than happy to answer any questions you guys might have towards the end. Now, switching gears into RightCapital. So today we're going to be looking at the Jane Austen family plan. And before we dive into a couple of the proposed strategies, we're going to evaluate what's happening with the current plan. And also just to understand this client a little bit better, we're going to be starting today's conversation off under the Profile Blueprint section. Now, under Profile Blueprint, this is where we can see that key, very easy to understand visual summary of the current path for the clients. So under Blueprint, starting with the net worth, we have a current net worth of $2.3 million. This includes their primary home. They do have an outstanding mortgage for their home as well. And they also have some nice investments in terms of tax deferred particular accounts or IRAs to know. So they are also in their mid-50s. They have a child that is about to be entering college next year, which brings us to the goal section. So they are taking a vacation this year for 2025. And then they're sending their daughter off to college in 2026 and on. And then we also have them retiring at age 67 respectively. They are going to be looking at downsizing their home at that point in time as well. And then they have some other normal retirement expense. Now, under the income, savings, and expenses section, this is where we can go to see what is happening with the current income streams, their savings habits, and expenses. So they have a current income coming in a pretty decent amount. They are also going to be filing for Social Security right when they are hitting full retirement age, which does line up with a retirement age, just to note. And they have some nice saving habits, and they also have some, of course, nice spending habits as well. Now, one of the first things that I want to address is when we're looking to modeling some of these strategies in the current plan, a couple of pieces can be added in the net worth section, and a couple pieces are going to be added into the goals. Now, to start off, I want to show for anyone that might have an existing donor advised fund, if we wanted to incorporate it as part of the plan, we can accomplish this in the balance by adding this in the net worth section, whether it's Profile Blueprint Net Worth or Profile Net Worth. But going to Profile Blueprint Net Worth, if we click on the Add button here, this is how we can add a new account towards their net worth. Now, to add an existing donor advised fund, we can go to Add, click on Investment, and then we can title this for our ease that this is the donor advised fund. And then we would select what type of account this is. A donor advised fund is going to be towards the very bottom. And then we'd select the owner, whether it's owned by the client, co-client, or jointly owned. And then we can enter the total balance, or we can enter ticker symbols if we wanted to. But let's say we just have some money already stored away in this donor advised fund. And then from there, we can also assign an asset allocation if needed. So we'll hit save, and that's how we can start to incorporate an existing donor advised fund as part of the net worth. Now, this is important for those that are looking to maybe use that donor advised fund or incorporate the idea of using the donor advised fund to donate to charity. So that's going to be one of the first steps for those that already have that balance established. And that then when we're looking at either proposing that strategy or incorporating as part of the current plan, we can then do so. Now, to incorporate some of these strategies for the current plan, that's when we're going to navigate to the profile goals section. Now, I'm going to be first walking through as part of the current plan how to illustrate pulling from that donor advised fund and then, donating it to charity. And then we're going to transition over to how we can curate a couple different charitable giving strategies. But under profile goals, we click on the add goal drop down. We can then navigate to the gift section and then select charitable giving. Now, the charitable giving card is a very versatile tool. This can capture a couple different aspects when it comes to charitable giving strategies. And it's very important that if we are looking to incorporate charitable giving in a plan, that we are leveraging this particular card, because this is also how we indicate that we're making that dedicated earmarked goal, especially because we have the idea of us leveraging this to hopefully mitigate our tax burden and potentially look at itemizing deductions by having a large enough charitable giving goal. So that's one of the topics for this particular family, is we're looking at leveraging itemized deductions and having a high enough itemized deduction to offset some of our tax burden. But in this particular instance, we're looking to pull from that donor advised fund. So we're going to title this goal as donor advised fund. And one of the first things that we can do is we would select what type of asset we are pulling from, and then we can designate which recipient we're looking to donate this to. Now, from the asset dropdown, we have a couple different options here. We can either pull from cash, an appreciated asset, the donor advised fund, which is what we're going to select in a second. But we can also use this to model the QCD, that qualified charitable distribution, whether it's the IRA, inherited IRA, or an IRA annuity. Now, I want to note, for if we are looking to model putting money aside into that donor advised fund, we can keep cash selected, and then we can choose that recipient. So we either have the option with this card to choose to donate to charity with that asset, or if we're looking to start to build out that donor advised fund, we can also select that option from here. But in this case, let's say we wanted to illustrate them as part of their current plan, pulling that money from the donor advised fund that's already established. Once we select the donor advised fund, we will see the recipient is grayed out. It's going to be locked into the charity because of the nature of a donor advised fund. From there, we can then specify how much we're looking to pull. Let's say it's, the full $10,000. And then from here, we can also indicate when we want this goal to occur, whether it's this year or future years. So this case, we're just going to say it's going to happen this year. And if we needed to, we can also make this a recurring goal, which we will for some of the other charitable giving goals. And then we'll hit save. And that's how we can capture the idea of us already having an existing balance for a donor advised fund or account, and also how to illustrate us using that donor advised fund to push that money aside to the charity. So that's one of the first steps, and that's how we can start to incorporate that as part of the current plan. So a lot of what we're focusing on today is really making proposed strategies and to show that key comparison visual and the impact in between our tax payments, between our current path versus that proposed strategy. To start to do so, we're going to navigate to the retirement module. And then under the retirement module, this is where we can access the analysis section. Here we'll be greeted with a probability of success. This is going to be looking at the Monte Carlo simulations, which are 1,000 trials of market volatility, and it's a percentage of those trials that make it to the end of plan without running out of money. Now, in the current plan, they have 100% probability of success, which is fantastic. But one of the key concerns for this family is mitigating their tax burden. So they're one of those families that are paying a lot in taxes. They're pretty decent income earners, and they want to see what they can do to really have a smarter tax plan. So we're going to be evaluating a couple of those different options. To start to carve out a proposed strategy, that is when we navigate down to the action items. The action items are where we start to illustrate changes to existing action items and propose those changes. Anything that we're modifying here is only going to impact proposed plans. So it's just going to be an important thing to note. Anything we propose here, or if we propose a new path, only impacting the proposed strategies, it's not going to impact the current plan. So for this particular strategy, we're going to be proposing a new path. So we're going to go down to the action items and click on the edit button. That's going to open up a drawer that allows for us to then either start to add or remove existing action items or propose new paths entirely. So in this case, we're going to be first proposing that they are making a charitable giving contribution to help alleviate some of that tax burden in the working years. And then we're also going to be looking at combining that with QCDs. So we're going to first add a charitable giving goal by clicking on add new items. going to goals, and then selecting charitable giving. From here, we can start to enter the parameters of this charitable giving goal. Now, for this family, we're going to be looking at contributing $50,000 to charity. We can then also select the owner, whether it's jointly owned or by a specific person. And then we can also indicate what type of asset we want to pull from. So whether we did want to pull from an appreciated asset or otherwise, we can select that information from here. And then we can indicate towards which type of recipient we're looking to make this to. So if we were looking to contribute to the donor advised fund, we also have that option. In this case, we're going to be sticking to just a pure charitable giving goal. We then also indicate when this is going to start to happen. So it's going to start this year. And then we can also indicate a frequency. So this will be recurring. So it's going to happen every 1 year. And then we can indicate when this goal is going to end. So we can either have that tied to a calendar year or have it be tied to a specific life event or stop at a number of years. In this case, we want to tie it to Jane's retirement. So we're just going to have this stop as soon as she retires. And we're going to be having this increasing with general inflation. Once we hit save, we will then start to see some of the impacts. Now, there's not a negative impact, which is exactly what we want to see. But one of the key things that's going to be important for today's discussion when we're really trying to dive into the details of the impacts of this strategy in particular is actually going to be the comparisons tab. So under the comparisons tab, this will be pulling from the cash flow level projections and comparing those cash flows between our current plan and the plan I have selected currently, which is my accelerating deductions plan. So cash flows is a different type of projection. That's a straight line projection. It's not factoring in volatility to the baseline, but we can apply different sequences of returns if we wanted to. But one of the key things here in particular is that we can use the comparisons drop down to toggle to taxes. So here we can see the difference between our tax payments between the accelerating deductions plan and the current plan. Now we can see per year how much we're paying in taxes. One of the things that we just indicated is that we're going to be contributing or kind of saving to charity while we are still working. So we can see here we already are starting to see a nice decrease in terms of tax payments as a result of that. So this is one of the first visual comparisons that we'll start to see a huge difference in as we start to carve out these strategies. And the next thing we're going to be looking at is modeling QCDs along this. So we're going to go back into the action items. And if we click on the edit button, that's going to open up that drawer that allows for us to propose a new action item. So we're going to once again select the add new items button. We're going to go back to goals and then add a new charitable giving goal. Now this particular one is going to be focusing on QCDs. So we're going to title this is Jeremy's QCD. We're then going to change the owner to Jeremy. And we're then going to change the asset type to the IRA that Jeremy has. We're going to select qualified charitable distribution. Once again, recipient's going to be grayed out. It's only going to be the option for charity because that is the purpose or intention behind that qualified charitable distribution from the IRA. Now for this particular QCD, we're going to be looking at $70,000 per year. And we're going to be having this goal start once RMDs start for Jeremy. So we're going to toggle instead of calendar year to Jeremy's age. We can then say 75 or whenever we wanted this to start, if after that. And then we're going to also have this be recurring. So we're going to have this happen every 1 year. And then we're going to change when the goal ends to a specific age, or we can have it end at end of plan. So in this case, let's just select Jeremy's end of plan. And then we can also have this be an increasing goal. So whether we wanted to tie this to general inflation and have this particular $70,000 be increasing each year by that 2.5% that I have specified for general inflation, or I can tie it to health inflation costs, education inflation, or customized inflation specification. Or we can have it not inflate each year. In this particular case, I'm going to have it be customized inflation by just 1.5%. So that way it still is a little bit of an increase, but not too much. But this is certainly something that can be customized as needed. So once we hit save, we will now see the difference between our tax payments between those two strategies. So you can see we're paying $760,000 less in total taxes than the current plan with this particular strategy. So already that's a great difference between the two plans. And if we're looking to start to dive a little bit deeper into some of the cash level projections, we can also do that by going to retirement cash flows, because I already see there's a couple questions about just kind of visualizing or seeing the details of this type of charitable giving goal. And under cash flows, we also have the MAPS visual. That's going to be summarizing a specific year into an easy to understand visual. So you can kind of see that here, but the summary space is going to be a great space to see the year by year breakdown of the client's cash inflows and cash outflows. Now we can see a couple different things here. We can first click into the goals column header to dive a little bit further into what is making up that goals section. So we can see that gift that's occurring, 50,000, increasing like I indicated. And then we also have the QCDs kicking on at age 75 for Jeremy. And we can see it's increasing a little bit. So we see the outflow, but we can also see specifically for the RMDs or required minimum distributions that start at age 75 for this family. We click in a plan distribution. We can also see when those start, and we can also dive into the total IRA distributions. So you can see the IRA RMD, and we also see the actual distribution coming out. That's the QCD. So that's going to be in line, this particular column, with the QCD, plus any extra that's required minimum distribution to satisfy that particular requirement. So you can see we do have a little bit extra. If we wanted to up the particular amount that we're making as a QCD, we can. And we see a little bit going on for Jane as well. So we could also add another goal for her if we wanted to. So we can see some of that information and just see what's happening at the summary level. So it's going to be one of the first spaces to start to carve out or just see the logistics of the QCD and also of that particular idea of the charitable giving goal. Now, another great question that I see is just where can we visualize the donor advised funds? So for anyone that already has an existing donor advised fund or we're building that out and we're looking to track that, we can also see that, but it's just going to be part of the net worth sub tab. So because it's kind of outside of the estate in a way, we're going to see it visualized under net worth here. And if we click on other assets, we can see any sort of balances that are outstanding per year for the donor advised account balance. So this is where we can see a lot of those logistics. We can also navigate to the account sub tab to start to see a breakdown of the ending balance by accounts per year. So we can also see RMDs from this particular section. So we can see those required minimum distributions being pulled from the tax deferred assets, the 401ks and the traditional IRAs. And we can also view withdrawals from accounts. The withdrawals from accounts particularly will capture that QCD. So it's going to be outlined here. And if we're looking to also see a full kind of net cash flows per view, meaning including the RMD plus the idea of the QCD, we can also see that from here. So it's going to be some of the important things that we can look at when we're trying to dive into the details of the cash flows with this strategy. One of the other settings that's very important to make sure that we have an understanding of that's going to particularly impact kind of those specifications for distributions in general is going to be found under the gear icon settings section. So under gear icon and under settings, this is where we can find our methodology page. But one of the very important specifications here that is relevant for today's discussion is the plan distribution method. This is relevant for, what we're modeling today, but it's also relevant for if you are specifying we're distributing any sort of funds from their tax deferred assets specifically. And we're also looking at the idea of RMDs. So for plan distribution method, this is the idea of how are we taking their RMDs and any manual distributions that you're specifying. So just for an example of what I have selected currently, I have selected greater of RMD and manual distribution. What this means is that any distribution from those tax deferred assets, if we had specified that we're going to be pulling, say, $70,000, just as that example, and that actually satisfied the RMD, we would see that actually go to satisfy the RMD. We wouldn't see an additional pull unless it's required as that required minimum distribution. So in other words, we also have the RMD added to manual distribution. This is a different type of purview or approach to how we would look at RMDs plus any distributions that you're specifying from those tax deferred assets. So for example, taking that idea of distributing $70,000 from a tax deferred asset, if we wanted to have RMDs be locked in, we're just going to still be incorporating that. We'd have that one column for RMDs and say the RMD was $70,000, and I specified I also wanted to distribute $70,000, then the total distribution for that year would be $140,000. So if we're looking to make sure that any distributions we're specifying at RMD age and beyond are going to be going to also satisfy RMDs, we would select greater of RMDs and manual distribution. And we also have the option to turn off RMD calculations altogether and just look at manual distributions only. So if for any reason we wanted to turn off that calculation, that is also an option. But in this case, I've selected greater of RMD and manual distributions, but I just wanted to highlight that this is an important specification for some of the things that we looked at today, but also just in general when we're looking at distributing assets in retirement or past age 75 for most families for RMD age. So it's going to be one of the very important settings, and this is something that's going to be applicable on a client-by-client basis. So if we have one client that's going to be a strategy we're employing, but another client, maybe we're looking at specifying RMDs are going to be set aside and distributions are going to be on top of those RMDs, you can have that specification per client. But going back to retirement analysis, back under this particular section, we can also start to carve out additional layers. So I do see a couple questions about being able to stack QCD. So can we also model a QCD for the client, for Jane? We absolutely can. So going back into the action items, we click on the edit button here. We can then click on the add new items button. And then from here, if we go to goals, we can go to charitable giving. And then we can start to model that QCD for Jane. So she didn't have a lot in terms of an IRA. So we're not going to be having a very large QCD for her, but we're just going to do a nice $10,000. And then we can change the asset type to IRA and then have this start at Jane's age, 75, and have this happen every 1 year. And once again, we can have this goal end either at a calendar year, after a number of years, her age, or end of plan. So let's say in this case, maybe we want this to stop at age 90, and we want this to increase a lot slower. Maybe we're doing just a 1% increase. And hit save. So once we specified that, we'll see that comparison. So the probability success comparison, still 100% probability success, but one of the key concerns for this particular family is mitigating that tax burden. So we've also incorporated that additional layer of Jane also performing QCD or qualified charitable distribution. We can go back to comparisons and view the taxes comparison. So you can see we've increased how much we're saving by not paying some of these taxes with the QCDs in particular. Now we're also achieving that philanthropic pursuit of donating to charity. So we can also accomplish that while also mitigating that kind of extra money we would have been paying towards taxes. Now, this is one of the spaces that we can see this information. We do also have further breakdowns available if we're really trying to dive into some of the pieces that are relevant when it comes to itemizing deductions and seeing that information and that kind of calculation, and also just seeing the tax picture in general. This additional information is going to be, of course, found under our tax module. So under the tax module, we'll find our tax estimate tab. And under the detail sub tab, this is where we can see the mock-up of the 1040 and various schedules. So here we can see for 2025, for the accelerating deductions plan, what is happening in terms of taxable income and some of the different calculations that's contributing towards their end of year total federal tax burden of $29,000. So we can also see how much they are taking in terms of an itemized deduction versus standard deduction. Now I want to note that in RightCapital, we will automatically take the higher of. So if they are going to be taking standard deduction, or maybe let's say their itemized deduction does not supersede their standard deduction amount, we would take the higher amount of standard deduction. So in the same kind of note that if we have very high itemized deductions. So if we had a lot of charitable giving goals, if we had maybe medical expenses and a couple other things, we would be able to see from here that we are going to be taking that higher amount from itemized deductions versus sticking with the lower amount of standard deductions. And we also can view those various schedules, like I said. One of the important ones for today's discussion is itemized deductions. So under Schedule A, we can start to see what is being considered those itemized deductions, including that gift to charity. We can see that we have the total itemized deductions for the year of $60,000, which we see reflected back on the 1040. So we can see some of that information. We will consider things like if they have any sort of interest they're paying for their primary home mortgage and a couple other pieces as well. So this is where you can see year by year how that's impacting their plan. One of the other ones that's going to be relevant is later on when we have RMD age. We can also see some of the pieces when it comes to just mitigating the tax burden in terms of IRA distributions versus taxable amount. So $529,000 for this particular year versus the current plan. So you can see also all of these projections when it comes to every single plan that you either propose or as part of the current plan. So we can see a lot of this information from here. We can also see itemized deductions. Now they're not going to have much just because the QCD is not going to count here, but we can also see those earlier years as well. So we can see we're not doing a lot in terms of itemizing deductions with the current plan versus our accelerating deductions plan. So this is also another space. Now I see that there's a lot of questions and I see a couple different things that people are looking to model. So I want to make sure we have time to answer that and also show some cases that people might be working on or think that are relevant. Before we dive into questions, I want to highlight the different resources that you do have available to you in RightCapital, including where you can find the recording of this webinar, because I see a couple people asked. But if we go back into our advisor portal, we can then click on the help button in the upper right-hand corner. That's then going to bring us to our help center, where you're going to find a lot of written articles that go over data entry. Maybe you're looking at the detail or written instructions on how to model, a donor advised fund or charitable giving goal. It's also where you can go to find our webinars as well. Now, since you are attending or you registered, you will receive a follow-up email with the recording. But if you lose that email or you're looking to, do some light binge watching over the long weekend of RightCapital content, we also have all of our previously recorded webinars listed here. So if you wanted to watch, a case study on Roth conversions, leveraging Tax Analyzer, looking at the cash flows in a deeper format, Medicare, anything like that, there's no shortage of content found here. For live support, if anyone has a more complex situation or they have questions after this call, under Contact Us Support, this is just going to list out the ways you can reach out to our fantastic support team. The first way that's ever present is the chat feature in the bottom right-hand corner that you can use to message the team directly for immediate assistance, or you can call the phone number listed here for immediate assistance as well. You can email them if that's your preferred method of communication. You can also book dedicated sessions with them as well. So this is also a great resource, especially if you have a longer list of questions, if you have a more complex illustration you're working on, whether you're looking at a very maybe complex annuity that you're looking at modeling, a vesting schedule, or charitable giving case, anything along those lines, they're more than happy to assist. And that set aside time can also be pretty beneficial in terms of one of our strongest tools in the system, which is our live support feature.